Well, thanks for coming in and watching this video with us, this conversation. Michael Weitzel is here with me. My name's Andre Ong. This is actually, we're brothers.
Hmm.
And we've been working together for a while, and we have been talking recently about what's going on in the market, what we're seeing, the trends that were happening for real estate buyers, real estate sellers, and what it looks like in the St. Louis metro area. So we wanted to pull up some of these numbers and some of these details for you to take a look at and just kind of have a conversation and let you jump in. So a little bit quickly about me. I've been well, we grew up in real estate, didn't we, Mike?
Yes, we did.
In
Yes, we
our
did.
business, it was our family business. It's what we're experienced with and just kind of know naturally. But I first started with my license in 2000. Um, Started with Mike's dad, my stepfather, and he trained me and then went on to work with uh, Terry Crackey, Fred Crackey. These are the guys that brought Remax originally to St. Louis. So quite a backstory there. Mike, talk a little bit, if you would, about your experience, why you went into loans, because you started with real estate too.
Yeah. So I started with real estate, I guess, when I was 18, working with my dad too. Um, and did that for a while. Our mother actually is a loan officer here at Guild Mortgage. And so I just thought it'd be nice to have kind of a complete understanding of the way the whole process works. So I started with loans about 3 years ago, and I've really enjoyed the business a lot. Um, and yeah, I mean, it's kind of like Andre said, something we grew up with, and something we're very familiar with. So it's a good business for us.
Okay. Yeah, it is. Okay. Now, the St. Louis market's gone crazy.
Definitely.
It is a different world and it's taking some different strategies. Why don't we look at a few of the details, some of the numbers. So we're gonna nerd out on you guys a little bit. We're gonna look at some of the statistics. Try and keep it simple and explain things as we go. Let me share this here so you can see. There we go. All right, Mike, is that coming through
Yep.
in the chart?
I
Okay.
see it.
So these are statistics that are being pulled directly from the St. Louis area MLS. It kind of gives you a statistical idea of what's happening with real estate, especially residential real estate, which is what we're focusing on in the area. I'm showing 4 lines, starting with St. Louis County, St. Louis City first, and then St. Louis County, St. Charles, and here you'll see the entire MLS. And these lines might get a little confusing, but just I'll leave them up so you can see them for a little bit. But here's the thing, and Mike, and we're looking back a year. And
Hmm.
we're talking about this a little bit, but if we go back January 2020, average, and this is how many months supply of homes were on the market. So we were at 2.2 in the city. Entire MLS was almost 3. So 3 months supply of homes. What's interesting about that to begin with, if we just go back to January 2020, is the National Association of Realtors considers a healthy market or an even market to be 6 months supply of homes. And
Yeah.
this is all based on the market, how many people would be in the market, how many properties there are entirely in that market. So it's an algorithm that they calculate depending on the region and where you're looking. So if
And it
we
really, it really seems like, at least as far as my experience, that we've been in sort of a low inventory market or a seller's market for the last 2 years.
Yeah.
I mean, as far as I can tell, it's been getting progressively harder to find property. And I kept thinking, okay, well, we're going to get out of this. It's going to go back to a buyer's market. And it just seems like it hasn't really. It's kind of gone further down.
And that's something that Angela and I have heard often now. That people are waiting for it to come back into being a buyer's market, and the prospect of that happening, it could happen, right?
Hmm.
We can't predict the future. My crystal ball is still in the shop, but um, the expectation that that's going to happen anytime soon, that seems to be, and you have to follow some different economists and market forecasters, it doesn't look likely. What I
Yeah.
find really interesting, and I just pulled this up today, is coming to our current numbers. In the entire MLS, we're down to 1.5 months. So we're at half the supply that we had a year ago, just a year ago. And you saw that, right? I mean, how many loans were you writing past this past year?
Oh, so much more. A
It's
lot more purchases. Yeah.
it's been a lot of activity in the entire MLS. In St. Charles, we're down to less than a month's supply. Uh, what that means, and I'll show a few of these numbers. What that means, of course, if supply goes down and demand doesn't change or demand goes up, we start seeing this trend where prices obviously are going up. And the actual what people are willing to buy, it especially in St. Louis County, we're seeing these prices climb. And so just looking at the numbers, we're going from in the entire MLS an average of 202,000 in January of 2020 all the way now to 237,000. That is, I mean, it looks gradual on the graph, but we would consider that a spike. And one of the challenges that has created is appraisers trying to keep up,
Right.
in appraising property at what people are willing to pay. People are willing to pay more. And Mike, you're going to go into a little bit of why that is. It's not just that they're willing to pay more; it's that they're able to pay more for the sales price. With fewer homes, they have to in order to get a property. So that's kind of what's going on in terms of sales price compared to the month supply. The other thing that's happening that I'm seeing is really interesting, and we're used to, real quick, and you know our process. We're used to being able to put a home under contract within a week. We have a specific way of doing that, right? We have a marketing strategy that builds demand for a property and reduces the number of times a seller has to open up their home. We usually put a house under contract after the open house. That all has to do with how we stage it, prepare it, and how we market it. But if we look at the number of days on market, and here the median makes more sense to look at. We go back a year to January 2020. The median days on market in the entire MLS was 48 days. So that was what you
usually sit on the market around 48 days until it would sell.
Right? Median.
Okay.
If your home was high demand, great shape, ready to go, very little work to do, and it showed well, okay, you're going to sell that within a week, 2 weeks, something short. If there was a little bit more going on, and also if a sale failed and it went back on the market, it's including those numbers. You were going to be on the market longer. You could expect, 1 to 2 months on average for a home. If you're in great condition home, you're going to sell much faster. And that's actually kind of fast still. When I came into the business, we were used to 60 to 90 days on the market.
Right. Definitely.
Right. Now, this also has to do with technology. You can find homes a whole lot faster. You can move a lot quicker. You can get your loan done a lot quicker. Things have sped up since 2000, but we still would expect a few weeks at least to be on the market. We look at where we are today in the entire MLS, it's down to 29. What's really interesting about that, though, if you look at the St. Charles area, again, which is very high demand area, that median number is 4. Now, the difference between average and median, in case, going back to high school math here, the median number is the middle number in a range. So let's say you have 30 homes and each one takes a day longer to sell. Well, the median number would be 15. It's halfway between 1 and 30. In this case, the first half is 1, 2, and 3 of those homes that sold. So half of the homes that were on the market sold in 4 days or less.
Wow.
They're selling fast. And we're seeing that, and we're getting multiple offers on properties. We're making multiple offers. We're at the point that, and we've been doing this for a while, that we're making multiple offers on multiple properties at the same time to try and get a client into a home. And it's very common to lose those offers because people are able to offer more than our clients are able to at the moment, depending on the property. What that looks like is a property comes on the market and we have to get out there and see it right away because it could very conceivably be sold by the end of that day.
Yeah.
and not available. I have clients right now that are try to schedule showings 2 or 3 days out, and by the time the showing time comes, the house is gone. So houses are selling fast, they're selling high,
Yeah.
and it's become incredibly competitive for buyers. And
Doesn't really give you a lot of time to move out and find the next house if you sell it in 4 days.
that's true, and that's the other thing. But everything's compressed, right? So you put your house on the market, you better be looking that same day,
Yeah.
trying to find something to replace it with. And of course, there's contingencies to protect for that. But these are the market forces that we're dealing with. So we have to have new strategies and ways of helping buyers. I mean, the reality is, and you know this, clients they have to move. People are
Mhm.
relocating. Their jobs are relocating them. There's more of a demand for homes that have an office so you can work from home. People are still having babies and they need another bedroom. So there's a necessity to be able to make these moves. Um, yeah, so these are market forces we haven't seen in St. Louis. Never saw this in St. Louis since 2000, and I don't remember it being what was going on, before I came into the business either. We had something similar when we were working in Southern California, but not to this extent. This market's going much faster than we were used to there. So I'll talk a little bit more later about how we handle this and what we can do. But I think the big point here is, getting into the market now. It's something that you can't do uh, on your spare time, a little bit here and there. If you need to buy a home, if you need to sell a home, this is something you have to do aggressively to be able to compete. So let's see, what else were we talking about, Mike?
Well, I guess what is you know, the concern about if you try to wait this out? I mean, some people it's not an option, right? That they have to move and they're just going to have to compete in this, let's say, cutthroat market that we have.
Right. Right.
Um, but say, you're in a situation where you don't necessarily have to move, but you'd certainly like to. What benefit is there to moving now as opposed to later?
Well, let me turn that back to you. Let me ask you
Mhm.
this: what do you think is going to happen for a buyer if they wait 3 months, 6 months, or a year on your side?
Well, yeah, on my side of things, I see a problem certainly with, and it's not necessarily a huge problem, but one thing that I think everybody who's considering buying a home in the next few years needs to be prepared for is that we have been living, and you've probably heard that the mortgage interest rates are incredibly low. And we've been living in a world where you can buy a house and pay 2.5% interest for 30 years. And for some people, that's buying their first home. They're like, oh, awesome. That sounds nice. What they don't realize is how incredibly low that is and how artificially low it is. So, generally, the stock market and the bond market kind of dictates what those interest rates are going to be on the homes.
Hmm.
But ever since the pandemic started, the Federal Reserve has been buying mortgage-backed securities, which is basically buying loans on the secondary market. And by doing so, they've made the interest rates go very, very low, as lower than they've ever been in history. Um, Now that's been really nice for consumers who are buying right now, and it's allowed a lot of people to purchase a home that, at a payment that they never would have thought was possible before. So what it directly translates to is less interest and buying a more expensive home and paying less for it.
So let me unpack that real quick, because I
Yeah.
think most of our viewers understand what a mortgage-backed security is. Let me go through that real quick. I have a background also in finance and wealth
Hmm.
management. So what most people don't realize is when you get a loan on your home, that loan you're accustomed to, it's going to whatever Guild Mortgage or whatever bank they're making that loan. Most of the time, especially if it's right a Fannie Mae loan or Freddie Mac, any of
Freddie Mac. Yeah.
they become conforming loans, they get packaged together and they get sold. Now, what happens is those loans are now offered on the public market, on the stock market, as a mortgage backed security. You can buy it like you'd buy a stock. and it gets more complicated there, but you can buy certain parts of them even. That creates a funnel of money that comes back into the mortgage industry that makes it possible to lend more money. Typically, these are
Right.
purchased by hedge funds, and they're purchased by accredited investors, investors with the higher net worth. And sometimes, and I have in the past had some clients that we were able to put into mortgage-backed securities. But
Mm.
so what happens is it's money flowing from the investor through the mortgages back to the mortgage companies so they can lend more. And so what you're saying, Mike, is the Fed started buying those.
Oh yeah. And the more they buy, the more money we want to lend, right? Because the more money we're making. So as they've continually bought more, the interest rates have been lower.
Okay.
So that's not to say that the interest rates are, terrible when they were before this started to happen. I mean, when I first started doing loans, around 3.5%, maybe 4% was a normal mortgage interest rate. When my manager started doing loans, a normal mortgage interest rate was 13%. Right?
Oh.
It's been that high before. He had to go out and sell that and tell people, but you can see how that would make a big difference on how much you're able to afford in terms of a monthly payment and how much money it saves you over the next 15, 20, 30 years paying the lower rate versus the higher rate. So I think the thing that people need to be prepared for is that the Fed is not going to continue to buy these mortgage-backed securities forever. They're not going to continue to artificially keep the interest rates low until the end of time. They have a target in mind, which is that they'd like to see around 2% inflation rate. And once we reach that, then they're going to start weaning off of purchasing those. And that means the interest rates are going to go up.
So your expectation and the industry expectation then is that we're going to see rates climb.
Yeah, definitely. I think the rates are most likely going to climb. It's very risky in this market to just kind of wait and see what the rates are going to be tomorrow. Because when most people go to buy a house, we get them, they get under contract, they're all ready to go. We start collecting their documents. And then they get to think about, okay, what's the rate today? Do I want to lock in or do I want to see if the markets will be better tomorrow? I used to love that game because, usually the rate would always be a little bit better the next day.
Right.
Maybe it'd get
right.
worse, even better. So I would try to, what's called float a lot of the interest rates. And, these days they've just been going up a lot faster. So what we're hearing from everybody in our company is if you got something that looks good that you can live with, lock it in and take that interest rate. Don't try and wait on tomorrow. And I can kind of illustrate that a little bit. Just what's been happening is people know, the powers that be, the speculators, the people who watch the financial markets, they know that eventually these rates are going to go back up. And just like if you're buying a stock, people buying these mortgage-backed securities don't want to be holding these when the Fed announces that they're not buying anymore, because that will devalue their asset.
Okay.
Everybody tries to not be the last one out for that event. We've already seen the rates go up pretty significantly, and I can kind of show that here. 1 second. All right, you see my screen?
Yep.
Okay. So this is just an example of our mortgage rate sheet. The rates in here aren't going to be accurate, so to speak. It's not like you could definitely have gotten this rate. These things, kind of depend on a lot of other factors. But what they can tell you is just the base rate, how much it's changed over time. So if we just look at my branch here, and we look at somebody buying with an FHA loan, a first-time home buyer loan that a lot of people get. And let's take this rate here, 3.125, okay? This is the cost to get that rate today.
Explain that, the cost.
So basically, when you go to lock in your interest rate, there's a a cost that somebody has to pay to buy that interest rate. Now, sometimes there are free interest rates, ones that you can get without having to pay anything. This one's pretty close. See this high rate here? You could get that and it would cost you 0.125% of the loan that you're getting.
And that's paid at
So
closing, right? So that's
at closing,
that's
it's like an
that's
extra
at
closing cost.
Okay.
So if you've got $100,000 loan, it's $125, right? This would be $500. Now, if you just go back and look at the historical rate sheets from, let's say 1 month ago. So we're on March 10th. Let's go to February 10th. So before you could get about a 3.625. It wouldn't cost you anything. And you could get a 3.125 for maybe $500. If we look at this 30 days ago, you could have got a 2.625 without paying anything. So we've gone from 3.6 to 2.6 in 30 days.
Okay.
And then maybe around 2.5 would have cost the same. And it's just been kind of a gradual change before then. I think in this last month is really when the market factors have started to decide that, the Fed is going to stop helping us with the rates any minute. And I actually have another little chart here. Can you see this all right?
Yeah.
Okay. So this is our the 10-year treasury note, right?
Okay.
Look back around here. This is a general predictor, and Andre, feel free to chime in here because I know you got a lot of experience with this. But a general predictor of the economy. It's basically what people think of the long-term economy, and they're willing
Right.
to invest in the future of the U.S. economy. So when we started out kind of in 19, here's where sort of normal rates were, right?
Okay.
And then when we get into 2020, we've come all the way down here.
Mm-hmm.
This is when we're getting the best rates ever. This is when, people were really worried about the economy and we didn't really know what was going to happen. As people actually gain more faith in the long-term prospects of the economy, at least the financial people do, what it does is it drives this price up, which actually increases the mortgage interest rates.
Yeah.
So as the stock market does better, it can actually raise the rates. And as you see, we've started to climb pretty rapidly back up to where we were. And how much higher we're going to go, hard to say. And then,
So
go ahead.
someone might say, well, then, I mean, there's a lot of talk about the stock market crashing and we're going to go into a depression and things like that.
Mm-hmm.
What actually happens, though, to mortgage rates in that kind of scenario?
In a depression, well, basically, you would think that the Fed would resume anything they were doing to try and decrease the interest rates, right? If we had a resurgence of COVID and everything shut down and the long-term prospects of the economy were not looking good, then you would expect the Fed to step in and try and deflate those interest rates again. But as the economy kind of looks worse, the interest rates would get better. Now, is that possible? Yeah, definitely. The economy could, take a turn for the worse. We could have increased shutdowns, but generally, and this is kind of an update from our market guru, David Batney, the prospects for the economy are actually saying, even conservatively, that by September, we should be on our way to, herd immunity, where about 302 million people have had the COVID vaccine. And that's another thing that's helping the economy is people are saying, okay, we see a light at the end of the tunnel, right? The total number of the US population roughly is 330 million. So we need about 264 million people immune to get to 80% herd immunity. When we get there, that's when the economy is considered recovered, right? Because we're not, COVID theoretically is a thing of the past, because we are, as a society, as a country, we're mostly immune to it, and it doesn't affect our lives as much. So conservatively, you could say by September 13th that we could be at that number, that we could be past this. And when that happens, the economy is going to do better. Interest rates are going to rise even more. And I would expect the Fed to stop helping by deflating the interest rates.
Yeah.
If you're optimistic, you might even say it could be as soon as April 8th that we could be reaching herd immunity. I guess somewhere in between.
I mean, that brings out a point that the reason the rates are what they are, and the reason they decreased so much, was the stimulus that the Fed put in by getting involved, right?
Right.
I mean, they pushed the rates down artificially. And the expectation that they'd be able to do that again, first you're making an assumption that they would be able to do that again. We can't say for sure. I think the other part of it, though, is there's not that much room to go.
Right. The interest rate is zero.
Yeah. So it's not like they can move the Fed rate much further than they already have, that they'd be able to make much of a difference. And then the other thing, and this is something we didn't discuss, but I noticed over the course, especially over the course of last year, the rates might have been low, but it got a lot harder to get a loan just to meet the requirements. And that would be something I'd expect again, that sure, the rates are low if that were to happen again, but would you qualify? You know, would a buyer qualify?
And that's a really tough thing about what's going on with the investors in this industry, the people that actually are buying those mortgages and funding the whole thing, is with COVID, they were, say you work at a factory and you're there, you've been there 10 years, but then this year you were laid off because the factory was shut down due to COVID for 3 months. When they look at your income for the year, they're going to take those 3 months that you didn't receive anything off of your income, and they're not going to give you any credit for the unemployment or any government assistance that you might have been getting.
Right.
So it was really tough on people who were forced to, not work basically for a while because of COVID, and there were really no sort of, safeguards or anything to help those people get approved for what they could afford, really.
Okay. Let me pull this up here because I want to show the difference. I'm going to switch the share here. So we're talking about changes that don't seem like much, right? You're talking about an increase in the rate from 2.625 to 3.625 in the past 30 days. Let's just say, let's do a $200,000 home. Okay. 30 years. And let's say your interest rate, if you were to buy a month ago, you got it at 2.625. Here's your estimated payment, $805 a month. That beats rent in a lot of places. You're able to purchase a home for 200. Oh, excuse me. I got to fix that. Let's get to the actual purchase price. 200,000. I really thought that was great. And we're going to put 3% down. Okay. 977. So you get a nice 3% down purchase. Michael works everything out for you. You're paying just under $1,000 on the actual payment. That's including homeowners insurance over here, estimated property taxes, 977. What is the difference if we just go up to where we are now at about 3.625? We've already gone up to 1,082, right? So we saw about $100 increase a month. That's $1,200 a year, and for some people that could change everything. So if the trend continues as we watch it go, let's just go.
So let's say 4.625.
4.625. Now it didn't just increase by it. We're at $1,195, almost $1,200. That is, and if you're doing the numbers for yourself and you're looking at your budget, you realize that this price is going up, and that's a price that you're locking in for 30 years.
Right.
And I think that's really important to understand is whatever rate you're getting now, you're locking that in. Let's say you're able to get in now, you get 3.625. You're looking at 1,082, 1,100 ish is your payment. That's your payment in dollar amount, right? So as we talk about inflation, and I hear a lot, I have clients that are concerned about, well, what if we actually have hyperinflation? Well, that works in your benefit in this case because you will always be paying $1,100, and the dollar might be worth less, and but your value is there decreasing. Does that make sense? The way I'm
Yeah,
explaining,
definitely. Hmm.
the value of the dollar has gone down, which means the actual value of the payment that you're making has decreased. In fact, there was a time I remember. Now this would have been decades ago, but I had a teacher once who said that when this last happened, this kind of change. Uh, his mom had locked in such a low rate at one point of somewhere around 3%, and rates had gone to 6, 7, 8% and higher. Actually, I think during in the 80s, we were looking at 13, 14, almost
Right.
20%. The bank started sending letters encouraging her to pay off her loan faster because they were losing money on the loan.
Of course.
He would rather be able to lend that money out at 20% than having to deal with it, 3 or 4%. So you end up in an advantage. So I think
Hmm.
that's the big thing to understand is, and if we look at this window, I'll stop the share here and we can discuss it. And tell me if you're seeing the same thing. To me, what this looks like is this little window of opportunity where you have the ability to buy a home at a very low rate. And sure, the price might seem inflated, and perhaps you could say it is, but you're able to afford that actual monthly payment, and you can count on that payment long term.
Definitely.
But as prices are rising, and we've had this happen in the past, you could get priced out of the market, right? So the houses could
Hmm.
get so expensive that you no longer qualify for a loan. And I don't know if you've had that happen to anyone yet. And
Oh,
second,
definitely. Yeah.
as the rates go up, again, you're going to have to pay more and you could get priced out of the market. So this is the opportunity to get the home, plan on being in that home long term, regardless, not knowing what's going to happen economically as we keep moving forward through pandemics and the political atmosphere and finance and all that stuff. But you can lock in that price and get that home now. So that's kind of what I'm seeing. It seems like a short window. I don't know how long it is, obviously, but from
Well,
everything that you've been telling me, we're only looking at a matter of weeks or months.
yeah. I mean, it's not looking, when we go up 1% in 30 days, I start getting nervous. So if that were to happen again, that's a big jump. So I would think now is the safest time to, make a move.
Yeah.
Definitely.
Well, I mean, you've seen this happen. You can have the difference in 1 point only looks like $100 a month. But have you ever
Mhm.
had someone not qualify for a loan because of $100?
All the time. Yeah. It's a game of inches, the mortgage business.
It's almost shocking when it happens. You're like, it's only $100, right?
Right.
But yeah, that's enough to lose a house, to lose a contract.
Hmm.
So we've
And
seen that.
I'm thinking about these people who are buying houses now. Are we expecting this low inventory to continue into the future just as people start to value the home more with all the stay-at-home orders? I mean, if you buy a house now, isn't the outlook on the housing market pretty strong that your home will continue to appreciate in value?
There's two sides on that, and I haven't found a straight answer that I could really rely on. And if you watch, I watch these economists and these
Hmm.
forecasters, and there's all kinds of them on YouTube. They conflict, and so there's those who say this is going to continue, and we can expect this long term. But that's also what they were saying before the housing market crash in 2008, that
Yeah.
that was going to continue. And then what they said afterwards is like, oh, actually, it was a bubble. Um, Anytime I see house prices increase this quickly, I start getting a little concerned. Could it continue? It could, uh, but it doesn't have to, right?
Right.
The thing is, oh, I'm going to wait for the bubble to pop. At that point, you're going to have much more. difficult time getting a loan, being able to buy that home, even though it's the people who are going to be buying are going to be cash investors.
Right.
And that also has those other ramifications of, dealing with employment issues and all the other stuff that comes along. So the
Yeah. I
market
mean,
doesn't become stronger for a buyer. It becomes chaotic.
yeah. I mean, and if you wait to buy, say you spend $1,000 a month on rent, say you wait 2 years, it's $2,400 you'll never get back. Whereas if you're in a house, that's equity in your home.
The other thing that we saw, in 2000, 2009, a lot of those first-time homebuyer programs, they weren't there. Just
Yeah.
last year, they suspended a bunch of those programs during COVID.
Yes, they did. Yeah, MHDC was the biggest one. It's our bread and butter, but it's back now,
Yeah,
for now.
for now. So, I mean,
Yeah, and Guild actually has a really great one. It's the FHA Zero Edge that they just
okay.
kind of rolled out. It's similar to the MHDC, but instead of kind of you have to live in the house for 10 years, it's only a 3-year obligation to stay in the home.
Huh.
And it's up to $5,000 that you can get in terms of down payment assistance. And there are other rates and, terms, conditions applied to that.
Yeah.
But if you're, thinking about buying a house, you don't have the money for the down payment, that's a really good one that I've been using recently.
Okay. That's cool.
Yeah.
So, strategies and talking about these difficulties, and now if you're watching this and you've been looking at the homes that are, that we've been emailing you the alerts, you've noticed, like we were showing you, that they're selling really quickly, right? They're disappearing.
Yeah.
So how do you get property? And one of the things that we've started doing again, and this strategy that we've used in the past, is we're looking for the homes, whether they're on the market or not, that would suit our buyers. And if they're off the market, we're approaching those sellers with an offer, a contingent offer. It says, we're willing to buy your home at this price. We'd just like to see it first to make sure that everything's okay. But literally approaching potential sellers that are not putting their homes on the market. Because if you're trying to find them on the market, trying to find them on the MLS, when they come out on Zillow or into your email, it might be too late. So that's one strategy. It requires us to put a lot more effort into it. But Mike, for me to send those offers out, I have to have a pre-approval.
Definitely. And I mean, the good news is, like you talked about before, is with technology, this entire process can move a lot faster than you might think. Some people think, oh, I got to apply for a loan. It's going to take me forever. With our online application, I can send people a link and they can have it done in 10 minutes. No problem at all. It's really not as bad as it seems. And once you've applied for the loan, there's no obligation, there's no cost to apply. And I can usually have someone pre-approved within an hour of them applying. Mm-hmm. So, if you're thinking about it, especially in this market where everything's so competitive, I just encourage people, just give it a shot. Let me work on it. And, I think we can sometimes, especially if we think we're kind of borderline, we have this tendency to put our head in the sand and we don't really want to hear the wrong answer. So we decide just not to ask the question. But I think you'll feel a lot better if you just kind of figure out exactly where you're at in terms of a loan approval. And it can be a quick and easy process. I try to make it a little fun too. So, yeah.
Tell me real quick, and I know people will say this, they don't want the hit on their credit report to get a pre-approval.
Yeah, I deal with people like that all the time, and I get it. It's only about 10% of your overall credit score is the number of inquiries. But if you're not sure if you're ready and you don't want to necessarily get your credit pulled right now today, what we can do is called a soft inquiry, which instead of checking the score for all 3 of the credit bureaus, we just check 2 of them. It still gives us all the information we need and gives me 2 of your 3 credit scores. We use the middle score. So between the highest and the lowest, we take those off and the one in the middle. So it gives us a range of what your credit score is. And I do that for people all the time. That's free as well. And you can always go that route with the loan application instead of pulling a full credit report.
Okay. All right. I want to wrap it up. We've been going for a little bit here, and let's finish the conversation. So as far as action steps, contact Michael, get pre-approved. Let's start looking at homes.
Definitely, it's fun.
Let me see if I can put up our contact info. And so there's that. There's contact. Is that showing up, Mike?
Mm-hmm.
Contact us. So there's our phone numbers. Angela, my wife, wasn't able to join us, but we work together as a team. She'll probably be doing most of the showings. Mike's ready to go. Get that pre-approval. We are always happy to answer questions. There's no cost or obligation. I say that all the time, to just ask questions and find out what we could do. See if this is the right time for you. It probably is. And start looking for property or sellers and get the ball rolling. So, sounds good. Mike, we need to do another video just about credit repair.
There's one up on my website right now on my Facebook.
There is? Did you do it?
Yes, I recorded a whole seminar about credit repair. It's on Michael Weitzel-guildmortgage.facebook.com. Feel free to like it, please. I need more hits on my website. And let me know if you have any questions. Call me, text me. Yeah,
text me the link. I'll put it in the description with this one.
Okay.
And maybe we can duplicate it into YouTube.
Yeah. Yeah, definitely. We can talk about credit repair. We can talk about first-time home buyer programs. So if anyone enjoyed this or found it informational, I'll be happy to do some more.
All right. Thanks, Mike.
All right. Thanks, bro.
I appreciate it. Let's get this.